Hey folks, David Frost, my strategic forecast. You're here for another episode of Common Sense Market Analysis. Today is Monday, February 12, 2018. We're looking at a daily chart of the SPY or Spider, which is the proxy for the S&P 500. So on Friday, we had a bottoming tail. We talked about that. And then we had some follow through today. Really was no surprise, or shouldn't have come as a surprise to anybody. We certainly could have gotten a retrace of that bottoming tail, but the futures opened up higher on Sunday evening, and then we had some follow through, and we had a nice big healthy up day on basically part of it was short covering, part of it was the feeling that the rally, or pardon me, the sell-off has come to an end and the markets are fine and everything is fine from here. That's probably not the case in total. However, we're likely to see another day or two of some upside activity. Following a bottom like this, it's not out of the question, and it is somewhat of, we'll say, common and normal market behavior for us to get at least 3 days of upside from the bottoming tail. That's not to say that each and every day is going to be up, and it's not to say that all day it's going to be up. So we can certainly start down tomorrow, fake out some traders, and then go up from there. So here's your big level. And you can see here the high of the red candle from last Thursday. That's going to be an important resistance point for the market. Why is that? Because the market had a lot of volume in that day or in that candle. 246.5 million shares. Unless we come up higher on more volume than that, or at least close to that volume, it's unlikely that we're going to just walk through that area. And that high comes in at, on the Spider, comes in at 268.17. So we kind of made an effort at that today on high, but we got rejected, not really quite up to that level just yet. We were about $1.50, $1.70 away from that level, and we're likely to test that level at a bare minimum before this is said and done. What we could do, and here's another scenario that could happen. Remember, we're in options expiration week this week. And what does that mean? That means that the large institutional players that slosh a lot of money around the markets each and every day, their job is to whip out the retail trader. When they see, for example, small lots of contracts on the E-mini or options contracts, they're going to take the market in the direction where they make sure that those contracts expire worthless. And I'm not suggesting that they're looking at, 5 options contracts and saying, we got to get that guy. But they see where the large majority of the small options contracts are congregating, and that gives them a target to trade either away from or to. Their job is to make as many options contracts expire worthless as they can. Remember, there was a lot of puts bought in the market last week, and the put-call ratio was extremely high, meaning more puts to calls on Friday. I think if I remember correctly, and you can go to the CBOE to check this number for yourself, if I remember correctly, it was about 1.2 or 1.3 to 1. That's high, and when the institutional traders see that, they're going to likely take the market in the other direction, especially coming into options expiration week. Here's your CBOE put-call ratio, 1.31, and you can see here the total number of puts was 5.2 million, and the total number of calls was less than 4 million. And you can see what happens when they see an imbalance like that. They're likely to make the retail trader pay, as it's the retail trader that's wrong the majority of the time. So what I began to say before is another option that could happen is we can come up to this, this level here that should be resistance to the market. And we can go sideways for a few days, and then we can have another push higher. Is that likely? It's possible. I mean, the 50 period moving average is going to be resistance, and then you have a down-sloping 20 moving average, and this area also will be another resistance point for the market. So there are levels above. It just depends on how far they want to push this market, and the market could certainly go up for another 2 or 3 days with no effort whatsoever, but I don't think we're out of the woods. We talked the other day from Friday's video about the fact that there were certain levels on the downside, specifically on the weekly chart, that just weren't hit. And this could be nothing other than an oversold bounce, a dead cat bounce as it's called. And we could have, and I wouldn't rule out at all, another down leg coming sooner than later. But let the market work off some more of this oversold condition. Let it go a little higher, and we'll get to see what kind of pattern begins to develop, and we'll get to see where the real resistance points are for the market. The ones I just pointed out are resistance points, but keep in mind, they're not all necessarily going to be hit, especially the upper ones. We may only just hit a couple of the resistance or nearby resistance points and turn back down. That's another possibility. The big level that I've got my eye on, and I believe I talked about this in Friday's video, is right around 270, maybe up to 271. That's going to be, and it comes right around where the 50-period moving average is, so that makes some sense. Maybe it's at 271.50, maybe it's slightly higher than I'm thinking, but that's basically a 50% retracement, so that you have the pivot high, you have the pivot low, and about 50% is right in that 270, maybe it's up to 271.50. That's an area where I think the market's going to likely find a pretty solid area of resistance. That's as far as I can tell. Before we move on to the next market, I just wanted to point out something that's pretty evident when you look at the 10-minute intraday chart. So the market gapped higher this morning, and almost immediately in the second 10-minute candle of the day, we made a new high, and then we began a trek downward. Where did we go? Well, it's pretty obvious where we went. We went to fill the gap that was left open from the gap higher today. So here's the close, this is the gap I consider the gap on, or from Friday. This is actually Friday's opening price on this candle, on this 10-minute candle, and then this 10-minute candle closed down here. It's a red candle, so the close is at the bottom of the body of the candle. But the gap officially is at the opening of this candle where the body begins. And what happened is we came down, we tested that level, we pierced through it by a little bit, we filled that gap, and then the market took off to the upside. That actually is common and normal market behavior. These are all things that are gone over in detail in my course at lazyeMinitrader.com. We'll take a look real quick at the IWM. We're back on a daily chart, and you can see it looks very similar to the spider chart. What's interesting to me, and as you know, this is my favorite market leading indicator on both the up and the down side, but the IWM was not leading the market in the upward direction today. It actually was up slightly less than 1%, and the spider was up almost 1.5%. So I find that interesting. I look at that as somewhat of a divergence, meaning that since the IWM was not leading the market on the upside, that tells me that under the covers, under the hood, there is some weakness still lurking out here in the market. Maybe the IWM catches up tomorrow and leads the market higher, and that whole conversation goes away. That's certainly possible, but I can't help but notice that the IWM on a relative basis to the S&P 500 was somewhat weaker as an index today. I have to take that seriously. Just like the spider, the same level is of great importance tomorrow, or whenever we do get there. It's right about here, which is the red candle high from Thursday in the IWM. It's unlikely that we just walk through that area. Officially, that high comes in at $150 even, so it's roughly slightly less than $2 away on the upside in the IWM. I think we'll certainly get there at a minimum on this move. I mean, there's more upside in this market. It's unlikely that we just turn back down and collapse from here, whether we're talking about the IWM or the S&P or any of the other markets. We were severely oversold, and in these oversold conditions, we likely get somewhere in the neighborhood of at least 3 days of a rally from a severely oversold condition where we did see a bottoming tail. The bottoming tail doesn't have to be a long-lasting multi-month bottoming tail, but on a daily chart, it's usually good for at least 3 days. Doesn't have to happen, but this is based on probabilities, and the probabilities say that there's likely more upside coming in this market. Taking a look real quick at the VIX, the CBOE Volatility Index. Now, it's coming down nicely. We hit a high of $50 on the VIX. Now we're half that number, just over 25. But as long as we stay, and we'll just call it above or in the vicinity of where this 20 moving average is right now, and those of you that have taken my course know exactly what I'm looking at, as long as we stay roughly above this level, call it 17 to 17 and a half, then that still is a bullish pattern, which means that it's a bullish pattern for the VIX, meaning if the VIX is bullish, then the market has more downside coming. That's how you have to read that. If we close below on a daily chart, $16.80 on the VIX, that bullish pattern gets taken off the table. But that's a long way down from where we are now. So the VIX, although it is coming down, it's still technically making a bullish pattern. As long as there's a bullish pattern developing on the VIX, there could be more downside in the market, and there likely is at some point in time. Just don't think it's tomorrow or even the next day of any big magnitude. But I think there is another leg down in the market. I don't think the downside was satisfied, as I discussed from Friday's video. The transports were obviously way oversold, put in a nice long tail, never did hit the 200 period moving average on the daily chart. I consider that somewhat of an unresolved position. It's not the tremendous deal that you would think it is. It's not that big of a deal, but nevertheless, it just should have been hit. That's the way I look at it. Chart looks very similar to the rest of the charts. When everything gets a lift higher, it's a rising tide, lift all boats scenario. We were up 1.6%, nice big healthy day for the transports, but the transports were actually the canary in the coal mine on the way down. We talked about it way up here when the transports were making a bearish pattern and they started to break down, and we said this could be the canary in the coal mine. The transports are certainly weaker than any other market out here, and that turned out to be the case. The transports got more oversold than any other market that we look at. The transports were way far away from home base. Home base is the 20 period moving average, so we do have some work to do to work off some of the oversold condition that now exists in the transports. So there most likely are higher prices coming, just as there are in the other markets. Moving over to the gold market, you can see here that we had an up day in gold today, up about $9 in gold, and we didn't get ever to the 1333, certainly not any higher than that. So technically speaking, this is doing what we talked about on Friday, is it's really making a bearish pattern. And this is a bearish wedge pattern developing. And unless we can close any day on a daily chart, close above 1333, then this is likely to play out to the downside. But it takes time to develop. These patterns need time. Time, as you know, or as you've heard me say many, many times, time is more important than price. We can certainly go slightly higher in the gold market, but unless and until we close above 1333 on the daily chart, then this market is susceptible for another leg lower. And at this point, the likely target, if we did have another leg lower, the likely target would be way down here toward the 200 period moving average. Anything below that, and there's something else going on, and we can go all the way down to double bottom. I don't necessarily think that's likely on this particular move, but if we play out this bearish pattern, right, so we have a down move, bearish wedge pattern, let's say we get rejected right around that 1333 area, then the next leg is going to bring us down probably slightly below the 200 period moving average, likely down to this zone right in here. Next up, we'll talk about crude oil. Crude oil had a nice rally today. However, the rally failed. Now remember the level that we were talking about midweek, even early last week, which was 58.25. We flagged that level. I said markets like to come back and retest former breakout and former breakdown areas. We did exactly that. We pierced through it by just a few pennies. 58.25 was the level. We had a nice bounce off that level, and the high today was all the way up. Let me just move this over. Was all the way up at $60.83. From 58.25 all the way up to $60.83, coming just short of the 50 period moving average, and price was rejected at that level. So we may struggle here for a while. We may put in a bearish pattern underneath the 50, or we may rally back up. It's way too early to tell, but the bounce that I would be considering or had considered from the 58.25 saying that that was going to be a lay down buy area, and I think I used that exact term. That bounce is over. Now, the market may go higher from here. That's certainly possible. I still think longer term there's higher prices coming in crude oil, but what I'm talking about is on a very short-term basis. We may go higher from here, but the type of rally that I was considering off the 58.25 area, that's done. That's over. You don't want it the second time around. It's a one-shot deal. The first hit is always your best hit. You basically got a $2.50 rally off the 58.25, and in the world of futures, that's $2,500 per contract in basically 1.5 trading sessions. Actually, it was less than that. It was really just a full trading session because it happened midway through the day on Friday, and we were rallying earlier today before we failed. So it was really the equivalent of one trading session. So that trade is over as far as I'm concerned. And with that, folks, it's everything that I really wanted to and intended to discuss tonight. So I'm going to give it a wrap here. I'm David Frost, my strategic forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.